Hi, it's Paul Pritchard here. Warning, this is not your boring Tax 101 article. You will learn something and save several $1,000s out of this. My key points are here. Most accountants are lazy. 9 out of 10 people I meet really have no idea if there's accountants getting as much as they can out of their tax returns each year. You ask them the question, but they don't really answer you. So what is your accountant missing, and how much more money is that in your pocket each week, each month, or each year? My second point is you need to treat your property, business, and investments as a business. Treat it as a professional would and spend the time and the focus on it. My third point is understand ATO profiling for your job or business, then also as a property investor and investor. There are guidelines that the ATO use to make sure that you're within those guidelines, and when you are, they'll leave you alone. My next point is know your stuff. Spend the time working on your stuff and prepare for tax, because that time that you spend on it will be well worth it. And in the end, no one else will. My last key point for this section is ask all the questions to your accountant. Don't be shy. That's what they're there for. You pay them good money, and that's what their job is. So don't be shy to ask them all the questions and empty your head. There are 7 common mistakes that most accountants and people make. The first step is all the interest charged. So that could be the interest charge on the property itself. It would be the interest charge on the home loan and the equity charge from your home loan. And then a common one is missing all the interest that was charged on your credit card that was used to pay the rates and all other business expenses. So make sure you allow for all the interest for all your affairs and all the payments for the year. The second one is business expenses. Because property and investment is a business, you need to treat it as such, as we talked about before. So make sure you've allowed for all the expenses associated with that, from insurances to rates to car to travel to all the advice that you got from your accountant or other property professionals or investment professionals, all the training, courses and education you had, even down to your internet and phone. So really look at it as a business and really note down what your expenses were for that business during the course of the year. Number 3 is the office or your home office. Most accountants miss that. There's some furniture to claim and then depreciation from that. There could be some phone, there could be some power, and some of them, when they're worth their salt, can claim a section of your house, so your mortgage payments and other things. So that's really important that the accountant's around your home office, or basically the office that is used for your business. Another good tip for this one is you can claim up to $1,000 each year for a laptop or a computer without much substantiation. I know for most people that's at least $300 or $400 in their pocket alone. So that's well worth listening to this article just for that. The next part is travel to and from your properties. You spent some time on travel. You also had some meals. You met some people. You called some people, and you zoomed through the internet. And that's all in just the due diligence time, or when you were doing your research on an area or areas. Then you have when you found a property or the area you liked, you spent some time before or pre to purchase and spent that time. Then during the contract period or when you're building, you've inspected that property a couple of times, haven't you? Then also know it's settlement time or at the end of the building. Make sure you go out, or you did go out to the property and have an inspection for that to make sure you're getting what you paid for. I'm sure you did that, didn't you? And then know, and this is a common thing that most accountants won't allow for, is you did go and inspect those properties twice per year. So as you can see, the business and travel expenses can really add up to a big deduction for you during the course of the year. If you need a more hand on that, let me know. So number 4 is no tax variation in place. A tax variation allows you to get more money in your pocket each pay period when your employer pays you. You work with your accountant to work out how much that might be, and then the ATO sends something to your employer to say, hey, this person's tax been reduced. So they'll give you more clear money in your pay every year. And my tip is to use that money to smash and focus on your home loan. Tip number 5 for me is scrapping and depreciation. So did you do any work in that property this year or last year? What did you take out of there? Light fittings or anything that was fixed, some carpet? That's all worth some money, and that's called scrapping. Then also, from my opinion, it doesn't matter how old the property is, if you get a professional quantity surveyor to help you and give you a report, there's usually always money you can claim out from depreciation on any property. So try that out. Point number 6 is don't be chicken to move away from a crap accountant. I've worked with people over the years and a lot of them are scared because this one's been working with my family for the last 10 or 15 years and they're scared to confront or talk or push the line with that accountant. Don't be scared, it's your money and you'll really get a better result somewhere else. So don't be scared to move away from a crap accountant. There are really good accountants out there that you can really use and make the most of your money. So my last point is you can't give anyone else responsibility for you or your money. You can't abdicate it. So really for you, you need to take it on board, be organised, be comfortable with your accountant and really get into it and treat it like a business as we talked about before. The more time you spend on it, the more money you'll find and the more money you'll get back in your pocket. So they're the most 7 common mistakes. So you might ask, hey Paul, what can I do? Well, I think there's 5 things you can do. The first is check your team. There are many different types of accountants. So does your accountant own 5, maybe 10 properties themselves? Because if that's your goal or if that's what you have, how can that person be expected to get all the best for you when they don't do it for themselves? Point 2 is go through last year's tax returns. Go through the 7 common mistakes we talked about previously and see what your accountant might have missed. And let's work together to quantify how much more money that might be back in your pocket. Point 3 is spend some time with your accountant before June 30 to go over where you're at, what you need to do, any ATO rulings and guidelines you need to follow, and how things might be changing for this year and for next year. My next tip is, in July, is spend the time to go through all your stuff and make sure you're ready and prepared and get it to your accountant by mid-August so you can lodge those tax returns and get that money back to smash your home loan, to buy that next property or to treat yourself to something nice. My last point is, if you really need a hand with this, send me your tax returns. I'll spend the time to go through them and I'll arm you with the questions to go back to your accountant with. Or I could at least give you the questions and give you a contact for accountants we know that can really push the line and get the most for you. So there's 5 things that you can do. So overall, what I'd like to communicate to you is all the small things add up to a massive difference for your results and for you. Every $1,000 makes a difference. And really from my experience, people with a few properties doing their tax right can save on an average of $10,000. So for me, take full responsibility for your tax. Take it on and master it because it'll be well worth your time. And just know, if you need a hand, we're always here for you. I look forward to meeting you. Cheers.